Where do I think the UK is going on the whole tax agenda, and what do I think that PARC members should be doing to prepare? Well, I think it seems that we are moving towards a higher tax economy. We've seen corporation tax cuts cancelled, and we've seen an increase in spending. Now that currently will lead to a bit more borrowing, but eventually that borrowing will have to be paid off, either in the form of lower spending elsewhere or in the form of higher taxes. Now, given the last 10 years of cuts, I think there are limited appetite for further cuts, so it's likely taxes will rise overall. However, I think that where tax rises take place, they'll tend to be targeted. I don't expect corporation tax to rise any further. I don't expect any of the main headline taxes such as income or national insurance to rise further. Indeed, I believe there is a tax lock on those taxes in the Conservative manifesto. I think what PARC members should be doing is looking at some of the more larger reliefs. We saw already entrepreneurs' relief cut. It may be the case that there are further reforms to capital gains tax. It might mean that the rate of capital gains tax rises while certain allowances are created. That could bring in revenue, although it may have a negative effect on investment. So I would focus on those areas rather than the headline areas such as national insurance, income tax. Business rates is probably the one where change is almost inevitable. I think the evidence militates us to say that we should move from a system of business rates where they're levied on the value of the property to a system where they're levied on the value of the land underneath. That may also help places such as the Midlands and the North, where typically land values are lower, but values of the property improvement, especially in the manufacturing sector, can be quite high. So that's what I would look out for. What is the size of the prize? How much could we increase investment by? Now, obviously some factors that determine investment are out of the control of the government, or at least out of the direct control. But one factor they can control is the tax treatment of capital expenditure. So our corporate tax system, when we usually spend on things like pens, paper, workers' wages, they can be deducted upfront immediately, but capital investments are deducted over a number of years. Now, as they're deducted over a number of years, it means that companies have to wait for those deductions, and money now is worth more than money tomorrow. That's why we expect interest on our savings. Now, if you compare the UK's treatment of capital expenditure to other countries, the UK performs incredibly poorly. So if you look at the OECD, the UK is ranked 33rd on capital cost recovery, the ability to fully recover those capital expenditures once you adjust for things like inflation and interest. By contrast, in Estonia, so we can deduct 57% of the true value across buildings and machinery. In Estonia, by contrast, companies can deduct the full value entirely. Now, how does that affect the level of investment in the UK? Well, we did some modelling, and what we found, based on a number of studies that looked at real-world cases where capital allowances had changed, that if the UK were to allow businesses to immediately deduct expenditures on non-residential structures and buildings, on investment in plants, machinery and equipment, it would increase the level of investment in the UK by 8.1%. And that would be a particularly significant change, and that would have knock-on benefits for workers. So we estimate that labour productivity, which is a function of the level of investment in the economy, because if workers have more machines, more tools to work with, they are more productive. We estimate that would raise labour productivity by 3.54% in the long run, or £2,214 per worker. Now, we estimate the above two reforms will have a cost to corporate tax revenues of around 0.47%. However, that's on a static basis. It doesn't factor in additional revenues resulting from extra investment, higher wages or more output. Then there are ways of funding this too. that make the tax system more robust in the future. For instance, we could avoid subsidising debt finance investments by restricting some of the tax deductibility of interest payments. Now, this proposal was put forward very recently by Sajid Javid. Sadly, in my view, it didn't make it into the budget because we had obviously a change in the chancellorship. But I do think it's an area that the Treasury is looking at, and it's an area that they'll probably revisit in the future